Welcome to today's video, how to determine your risk tolerance in investing. One of the most important things to understand when you are investing is your risk tolerance, because you can lose a lot of money if you are being too risky with your investments, if it is more than you can handle. But if you can get that right, then you can make a lot of money. So let's dive right in. All right, we are going to talk about what is risk tolerance, why it's important, and then how to determine your risk tolerance in investing. All right, what exactly is risk tolerance? Risk tolerance is the level of risk that an investor is comfortable taking on their investments. This varies greatly from person to person because of financial goals and their investment knowledge, and also their personality. And then why is risk tolerance so important? Understanding your risk tolerance is important because it can help you make investment decisions that align with your own financial goals and your own personality. Investing in high-risk investments, if you have a low risk tolerance, is just setting you up for disaster. It could cause you to feel anxious or very stressed. But on the opposite end, if you're investing in low-risk investments when you have a high risk tolerance, then you are missing out on potentially higher gains. We really want to understand our own risk tolerance so that we can still make as much money as possible, but not be so stressed about our investments. All right, let's talk about how to determine our own risk tolerance. And there are actually several different ways to determine this. There are questionnaires that you can take, or you can assess your own past experience and how you've reacted to market fluctuations. But in today's video, I'm just going to keep this very simple and we're going to base it on two factors. The first factor we want to take into consideration when determining our risk tolerance is how market fluctuations affect you personally. For example, if you know the stock market is going down, are you freaking out and pulling out all of your investments? Or are you pretty calm and thinking, all right, I know it's going to come back up over the long term? I want you to think about how you would react if you put in $100,000 in the stock market and the next day it went to $50,000. It dropped to half of your investment. How would you react to that? And then the second item we want to take into consideration is our time horizon. How long do we have to invest our money? Is it a very short amount of time? Is it maybe 5 years or 10 years? Or is it 30 years, 40 years, 50 years? We want to know what that time horizon is. But before we determine our risk tolerance, taking into account those two factors, it's important to understand the different types of risk that go along with investing. Because if we can understand these types of risk, we are going to be better investors. All right, the first thing that we want to talk about is balancing risk and reward. High-risk investments have the potential for high reward, but it also comes with a higher chance of losing money. Low-risk investments, on the other hand, have a lower return, but also come with a lower chance of losing money. So we want to balance our risk and our reward. And then the second thing we want to talk about is adjusting our risk tolerance. This can definitely change over time. We don't have to just keep the same risk tolerance, especially because of the time horizon. But over time, as your financial situation changes and your goals change, we can adjust that risk tolerance. For example, if you are getting really close to retirement, you may have a lower risk tolerance. Rather, if you are further away from retirement, you may have a higher risk tolerance. So we want to continue and adjust our risk tolerance depending on our own situation. And going back to how we will react to market fluctuations and our time horizon, let's really think about our risk tolerance. And we'll just use a scale from 1 to 5, 5 being the riskiest. And I want to share a quick example with you. I have a friend that I was going to church with, and she had told me about her experience in investing in the stock market. I don't know exactly what she was invested in, but she had a significant amount invested in the stock market. And the stock market actually went down, so she saw her investments drop significantly, and she got so nervous that she pulled all of her money out of the stock market. All of it. She closed her accounts. She didn't want anything to do with the stock market. And if you can guess what happened, not too much later, investments started to come back up and she completely missed out on all of the gains she could have had if she would have just left her money in the stock market. And saying that, there are some investments that we might make that are no longer good investments, so we want to be analyzing our investments. Is the reason that we bought that investment still true, or has it changed? And if it has changed, maybe we do want to pull out our investments. But if we are just becoming so nervous and fearful about our stock market investments dropping when the entire stock market is dropping and pulling that money out, then we are actually locking in those losses, and we were just being too risky for our risk tolerance. And I know when I was first investing in the stock market, I was really nervous. I thought I would lose all of my money. But as I gained more and more education about investing in the stock market, I knew that that was not true. I wasn't going to pick a super risky investment. For example, I wasn't going to pick a brand new company on the stock market and put all of my money into that company that could potentially go bankrupt very, very quickly. I learned what to invest in. I knew what my comfort level was, and I wasn't too risky for myself. But what really helped was the education part, educating myself and realizing that if I am investing in the stock market in good investments, that it will continue to rise over time. In the short term, it's going to go up and down, and sometimes down really far, but sometimes up really far. But over the long term, it's going to go up. So really think about if you made that $100,000 investment and then the next day you see it drop to $50,000, are you going to pull that money out? Or will you think, oh, the stock market's on sale, I need to invest even more, and realize that it will come back up over the long term. So if you are thinking, oh, I would definitely sell all of that, your risk tolerance is going to be very low. You'll be closer to the 1 on the 1 to 5 scale. But if you're thinking, oh, I can definitely invest more because everything is on sale, and you get all excited, you'll definitely be up in the 5 level on our 1 to 5 scale. And then we want to take into account our time horizon. If we have a long time to be investing, then we can be more risky with our investments because we'll be able to get that higher return because we will have a longer time frame to get that higher return. And I'm not saying that we should be risky and invest in brand new companies and just put all of our money in one company, right? I'm talking about being risky by investing in an index fund that has all stocks inside of it or something like that. We want to take a calculated risk and not just be risky and not really understand what we are investing in. And if we have that shorter time horizon, then we may want to be less risky. We may want to put some of our money into bonds and we can keep some in stocks. For example, if we are maybe 5 years away from retirement, we can put more into bonds, maybe 30%, and then do 70% in stocks. It really depends on you. You want to be comfortable with your investments. You don't want to be selling all of them if they drop. So think about your own time horizon. The longer you have, the more risky you can be. But also you want to know how you will react to different market conditions. But honestly, the thing that helped me the most was getting the most education about stock market investing and then actually doing it myself. And if you want help doing that, I have a free masterclass where I go over how I can help you do that. I will leave a link to that below in the description. You can click on that and check out the free masterclass. Just keep it very simple and take those 2 items into account, how you will react to different market conditions and your time horizon. And then you can figure out on a scale of 1 to 5 how risky or what your risk tolerance will be. And then remember, you can adjust that over time. And if you are thinking I'm a 5 on the risk tolerance scale, then you can be investing all in stocks. If you are a 1, you can have a lot in bonds, but realize that you are going to be missing out on potential returns. So you're going to have to invest a lot more money in order to reach retirement. And if you are a 3 on the 1 to 5 scale, then you can still have a majority, maybe 70% in stocks and then 30% in bonds. You want to feel comfortable with your own investments, but keep in mind, if you're investing in stocks, you're going to get a higher return, but have that potential for a higher loss. But keep in mind, if you do have that longer time horizon, that it's going to go up over the longer term. I personally am investing only in stocks. I do not have any investments in bonds. I'm fine with being risky. I would rather grow my wealth, which stocks does, than preserve my wealth right now, which bonds do? Comment below and tell me your risk tolerance number, 1 being the lowest amount of risk and then 5 being the highest amount of risk. I am curious to know. And if you found this video helpful, please hit that like button and share it with someone else who would like to hear this information. And make sure and hit that subscribe button to subscribe to my YouTube channel and hit the little bell to get notified on when I post new videos. And if you want to see even more content from me, make sure and check out the videos on the side of the screen. Thanks so much for watching. I'll see you in the next video.